This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This is the first of two chapters dealing with corporate governance. And corporate governance, as it says here, is the system by which companies are directed and controlled. You may have seen already in lectures, or you certainly will see in lectures, the idea that there's a division between the shareholders and the directors. Now, in small companies, the shareholders probably are the directors, but as companies grow, these functions divide, and shareholders, certainly listed companies, really have very little to do with the day-to-day, nothing to do really with the day-to-day running of the company. And that set of duties is given to the directors. The shareholders are the principals. The directors are the agents. And it is the legal responsibility of the directors, the agents, to act in the best interest of the principals, the shareholders. But you can see there's a potential kind of conflict here. Directors have the day-to-day power to run the company, and are they really doing that in the best interests of the shareholders, or are they perhaps running the company more for their own benefit? Historically, and still there is an annual general meeting once a year, this is where the shareholders can go to this meeting and vote. And they can vote to get rid of directors, to change auditors, or to approve this, that and the other, and so on. But that's only once a year. And they get the financial statements once a year, the accounts once a year. So they get once a year a little kind of snapshot of how the company is doing. And to give some credibility to what they're being told, those financial statements will be audited. An independent review and examination of what the financial statements are saying. So this isn't very often. I mean, there could be 15 months between one AGM and the next AGM. This gives the directors an awful lot of time to be getting on with stuff which maybe isn't in the best interest of the shareholders. There are supposed to be regular board meetings of the directors, and it's supposed to be all of them. But quite often what was happening was you had a very powerful director, almost a bully-like figure, or certainly a very charismatic figure, who was the chief executive officer. And this person, rather than airing matters at the board meetings, would take one director aside and kind of get agreement with that director, and then separately another director, you would persuade them to be on your side. So when it came to the board meeting, everyone had been kind of converted to the CEO's point of view, and there was no real discussion. It would be very difficult for any single unconvinced director to make much objection to these plans. And it wasn't until there were big financial failures in the early 2000s, we had Enron and WorldCom. Enron was a huge energy company. WorldCom was a huge communications company. And then in 2008, Lehman Brothers, banking company, large corporate failures, got governments and regulators to begin to look more carefully at what was needed to have good corporate governance. And broadly speaking, sets of rules were brought in, or approaches were brought in. And the first approach, which is adopted in the United States, something called the Sarbanes-Oxley Act, was passed. This is part of US law. And this is what's known as a rules-based or procedures-based approach. And basically what you have is you have checklists. You have a list of really questions. Have the directors done this? Have they done that? Have they looked at that? Have they examined that? Etc., etc. And also a list for the auditors. And people have to sign it off. So it's a very strict kind of checklist. And there are criminal sanctions. There can be jail waiting for people who sign off these checklists erroneously, trying to mislead people. The great thing about this, and it was a bit like the ethics approaches, is that you have to answer all of the questions, and there's evidence about what you've said, but they maybe, if you don't ask a question, won't be answered. They're maybe not very flexible. The other approach is the principles or framework-based approach, which most European countries have taken on. So, for example, in the UK, we have the UK Corporate Governance Code. This is not law, it's not statute, it's a code, and it's enforced by the stock exchange. So if a company is listed on the stock exchange, it has to comply with this code, or else give a very good explanation about why it has decided not to comply with a certain aspect of the code. And if the explanation isn't good, if the company seems to be ignoring the code, then the listing of the company on the stock exchange can be suspended so nobody can deal in the shares. This is a framework-based approach. It sets out certain ambitions almost about what should be found in good corporate governance, but doesn't necessarily lay down precisely exactly how good corporate governance is to be achieved. It's therefore arguably much more flexible. Now, when these kind of scandals had come out and so on, the OECD, that's the Organisation of Economic Cooperation and Development, brought out some high-level principles of corporate governance. And then they left it up to national governments and regulators to decide how to implement these high-level recommendations. So in the US, they went for Sarbanes-Oxley. In the UK, they went for the UK Corporate Governance Code. What the OECD was hoping to encourage was a promotion of transparent and fair markets. So a transparent and a fair market would be, for example, you don't give some shareholders information that you don't give to others, because you're giving those shareholders an advantage. It would mean not concealing events. So if you had a takeover offer on your company, you should announce that pretty quickly. Otherwise, people might be buying and selling your shares without knowing there was this takeover there, and maybe they wouldn't sell the shares because if they'd known about it, because they're hoping for a high price. It is to protect and facilitate the exercise of shareholders' rights. So shareholders must be invited to the AGM. If we are disseminating information to shareholders, we must make sure we spread the same information at the same time to all shareholders, particularly minority and foreign shareholders. There had been a kind of a habit in the City of London, and you realise that the stock exchange in the City of London is a great financial hub. Many pension funds are based in the City of London, and investment trusts and so on. And if a pension fund, let's say, owned 15% of your shares, then there was a temptation for the finance director to take the investment manager from the pension fund out to lunch or something, and you discuss with this powerful shareholder how your company was doing. But if you only own, let's say, 1,000 shares, a relatively small shareholder, you didn't get those bits of information, those little nods and winks and hints and so on about what was going on. Similarly, if you're dealing with a company which is quoted in London, but you're based maybe, say, in Sydney, Australia, you to some extent are out of the loop. You don't hear the gossip. You're not talking to people at lunchtime in the same way, and this could be unfair to foreign investors. We need what's called the provision of sound investments through the investment chain. Most people don't invest in shares directly. They will invest in shares through their pension fund or through investment trusts or through what's called ISAs, which is a kind of savings device which gets favourable tax treatment and so on. And we must make sure that the investment trust companies also deal fairly with investors. So there's this transparent and as pure as you can get it relationship between the company and its investors. We should recognise the rights not just of all shareholders but of all stakeholders. So stakeholders, anyone affected by the organisation, could be employees, directors, managers, can be customers, it can be competitors, it can be suppliers. So the OECD was interested in just spreading the duties, if you like, of a company beyond what had been a very strict duty to maximise the wealth of shareholders. This is trying to say, well, you also have to take into account maybe what you're doing to the employees, or maybe what you're doing to suppliers, and so on. And there are certain resonances with this idea to what you'll see later, which is the idea of corporate social responsibility, where there is encouragement for companies to be good corporate citizens, to go further than the law might demand. We want timely and accurate disclosure of all relevant information. So like the takeover bid, or if you're a pharmaceutical company and you find one of your drugs has to be withdrawn because of safety fears, then you have to announce that quickly, because if you don't announce it, your share price will be kind of left up there, but really if people knew the truth, your share price should drop. And you're not being fair on people, either buyers or sellers, if the share price doesn't properly reflect the value of the company. If it doesn't, the technical term is if the share price is not, or the market is not efficient, if it does not efficiently take on board and reflect events. And finally, it's important that part of corporate governance is not just to look at this year's profits or are we going to hit this year's budgets. Most investors are interested in the long term. They want to know, what's this company going to be doing in 5 years, 10 years? Do I want to hold on to it for 5 years? Do I want to put it in my pension fund, which I'm maybe not going to be drawing on for another 30 years? So short-term profitability is very much second to longer-term profitability and what you might call a sustainable competitive advantage. And it is the duty of the directors to look long-term, to take a strategic view on what the company should be doing. IFAC, the International Federation of Accountants, has come up with a list of what should lead to sustainable long-term or strategic success here. I'll just go down the left-hand side of this, I think, here. The full explanations and lists is provided in the notes there. So the company should focus on customer and shareholders. You get money from customers, you are reliant on customers to give you profits, and you should be looking at what shareholders want. And the sort of thing you need to look at for your shareholders is you could offer them relatively high returns, but maybe relatively low risk. Or would your shareholders rather have a less risky type of strategy, but probably giving them less return? You have to focus on your customers, because you'll only make profits if you produce goods and services that the customers are happy and willing to spend money on. It's important that there is good and effective leadership and strategy, and of course this should be led from the top, from the board of directors. Strong corporate values, strong ethical culture there, good organisation and so on, and leadership from the top. Integrated governance and risk control. For example, we have something called maybe internal control. We have to keep watch on where the money is going. We have to make sure that assets are safeguarded and so on. And there's always a tension going on here. How much performance do we want, and how do we, to get that performance, nevertheless make sure people don't take too many risks? What is the conformance? Certain rules that people have to live by, and we hope that this provokes good performance within the company. Risk management is important. We want to keep an eye on the risk, particularly the downside risks, things going wrong. And we want to say, well, here are the 5 big risk areas that could lead to huge loss of value. What am I doing about them? Maybe we can avoid some of them entirely. Maybe we can mitigate them in some way so that we are alive to these risks. Innovation and adaptability. It's important that companies keep moving. Particularly nowadays, there's very high speed of technical change and innovation, and companies must have some strategy that means they're not left behind, because very soon, if you're left behind, somebody else will come above you and have an even better. Just think of Nokia. So Nokia, about 10 years ago, probably had 60% of the mobile phone market. Nokia kind of stuck with old technology, old operating systems. And then with Apple coming in with the iPhone, and of course stole the market, and Nokia is barely ahead of again. Financial management. We need good financial management in areas such as tax and cost and profitability. We need to make sure we get regular management of accounts, proper analyses so we know what's going wrong, what's not going so well. We need to make sure we manage the working capital so we don't have some embarrassment when we can't pay the rent or can't pay the salaries. People and talent management. Sophisticated organizations realize that ultimately the secret of their success is people. If you don't have good people, you will certainly not have good innovation, you will not deliver good services, you will not create good products. And making sure that you can recruit the right people, train them, keep them, motivate them is absolutely essential to sustainable competitive advantage. Operational excellence. If we're going to keep our customers, we have to do well what we say we're going to do. So different companies have very different operations. If you're a hotel chain, if you're proclaiming yourself to be a luxury hotel chain, that's why customers come to you. You must make sure you can live up to your promises, that the food is good, the service is good. If you may be a cheaper hotel chain, and that's why people come to you, nevertheless, you must make sure that you give what's written on the tin, really. You must have rooms which are clean, the Wi-Fi works and so on. You mightn't provide particularly gourmet meals, but you're not promising that. So whatever you promise, you have to deliver on. And finally, effective and transparent communication, ensuring that shareholders receive the relevant information, that they receive it promptly and quickly, that they can make proper decisions on it, and so on. And to decide what constitutes high quality business reporting. And we'll see later on when we look at corporate social governance that there's now something called a triple bottom line approach, which says that maybe companies shouldn't just be reporting on their financial performance, they should be reporting perhaps on their kind of social, their human resources type performance, and they should be reporting on their environmental performance, how they're conserving the environment, saving electricity and gas by reducing their carbon footprint. CIMA's proposals in relation to corporate governance, they say it's important to set the tone at the top, that the board in particular, maybe the CEO, and their attitude and setting the culture is immensely important. We have to look to see how the board works as a team. Does it integrate? Do they discuss things all together at the board meeting? Do they take proper majority decisions, or is it some powerful chief executive pushing through, really in the face of opposition, pushing through their pet project, which may have no real prospect of success at all? We need to look at the key actions of the board and its committees to make sure they're all fulfilling that. We'll see in the next lecture the various subcommittees that you'd expect to see in the board to keep it functioning well. Its effectiveness, who should be on it, what sort of people should we be recruiting? Should we try to shift people on after 5 years, get new blood in, and so on. Should the board be trained and the like? And then finally, there is communication and engagement with shareholders. Old-fashioned boards, where you had your once per year AGM, really almost found the AGM a bit of a nuisance. It was the shareholders, the owners of the company, coming once a year to ask awkward questions and maybe to vote something down. And in many ways, directors would have preferred shareholders never to have turned up. Now, it's changed. There has been encouragement, and it must be said that some shareholders were their own worst enemies. They took a very, very much kind of passive backseat sort of role in what their company was doing. But now the emphasis is try to get the shareholders along. They, after all, are the owners. You have to try to engage with them. You have to send out maybe bulletins every quarter, updates every quarter, to let them see how you're doing and so on. Keeping them in the dark, although it might be nice for the directors, is certainly not good corporate governance, which is looking at how companies should be directed and controlled.